Hello and welcome. Today, we are going to be demystifying one of the most powerful tools out there for building long-term wealth, the equity fund. Now, if you've ever heard that term and felt, a little bit lost, stick around. We're about to make it all crystal clear. You see them mentioned all the time, right? Financial experts are always talking about them. They pop up in the news. But the question is still there. What on earth is an equity fund really? Well, it might sound complicated, but I promise you the main idea behind it is surprisingly simple. Let's break it down. So let's start with the absolute basics. Think of an equity fund as your personal guided entry point into the huge world of the stock market. At its heart, an equity fund is basically a big pool of money. Lots of people, just like you, put their money together, and then a professional fund manager takes that big pile of cash and uses it to buy stocks in a whole bunch of different companies. So what this means is, when you invest, you're not just betting on one company. You're instantly buying a tiny piece of many, many different businesses. Okay, so this brings up a pretty logical question, right? If an equity fund is really just buying stocks, why not just cut out the middleman and do it yourself? Well, turns out there are some very, very good reasons for that. Think about it like this. Buying individual stocks means that you have to be the expert. It takes endless research, you have to track how every company is doing, and you have to decide when to buy or sell. Honestly, it can feel like a full-time job. An equity fund, on the other hand, gives you two huge advantages right off the bat. A professional manager who does all that research for you, and instant diversification. By spreading your money across tons of stocks, you're not putting all your eggs in one basket. It's just a smarter way to manage your risk. All right, so we get what they are and why they're so useful. The next big question is, how do they actually make you money? And, what are the risks we should be thinking about? Your investment can grow in two main ways. The first is something called capital appreciation, which is just a fancy way of saying the stocks the fund owns become more valuable. As those companies do well, their share prices go up, and that increases the value of the whole fund. The second way is through dividends. A lot of companies will share a little slice of their profits with their shareholders. When the fund gets those payments, it passes them right on to you. Now, here's something that is absolutely crucial to understand. The stock market is volatile. It goes up, it goes down every single day. Because of all that short-term noise, equity funds are really not for making a quick buck. They are built for the long haul. The general rule of thumb? Plan on staying invested for at least 5 years, maybe even longer. That gives your money enough time to ride out all the bumps in the market and really have a chance to grow. Okay, it's also really important to get this. Equity fund is a pretty broad category. Not all funds are the same, not by a long shot. They're actually designed for different goals and, different comfort levels with risk. So funds are often grouped by the size of the companies they invest in, which is called market cap. Large cap funds? They invest in those huge, stable, household name companies. Think lower risk and steady, moderate growth. Mid-cap funds focus on those medium-sized companies that have a lot more room to grow, which means, a bit more risk, but for potentially higher returns. And then you have small-cap funds. They invest in new, emerging businesses with massive growth potential, but, and this is the trade-off, this also comes with the highest level of risk. So let's say you figured out what kind of fund might be the right fit for you. Now what? What's the best strategy for actually putting your money to work? Do you try to save up a big lump sum and then try to dump it all in when you think the market is at its lowest point? Or is there a more disciplined and, frankly, less stressful way to do it? For the vast, vast majority of investors, the answer is something called a systematic investment plan, or SIP. It's actually incredibly simple. You just commit to investing a certain amount of money automatically at a regular time, say on the first of every month. And this simple approach has 3 incredibly powerful benefits. First, it just builds discipline. It automates good habits. Second, it totally removes the stress of trying to time the market. You don't have to guess anymore. And third, it helps smooth out all that volatility. Think about it. When the market is down, your fixed amount of money buys more units of the fund. And when the market is up, it buys fewer units. Over time, this averages out your purchase price, which is just a super powerful strategy for dealing with market swings. We have covered a lot, the what, the why, and the how of equity funds. So let's bring it all together now with the single most important lesson to take away from all of this. This is probably the most valuable piece of investment advice ever. Seriously. Success with equity funds doesn't come from being some kind of genius who can predict the future. No, it comes from consistency, from discipline, and from patience. just staying invested through the market's ups and downs is so much more powerful than trying to jump in and out at the perfect moment. So, if you remember just one thing from our conversation today, please let it be this. Investing in equity funds is a marathon, not a sprint. They are a tool for building wealth slowly and steadily over many, many years. If you can embrace that long-term perspective, you are already on the right track. All right, just a quick but important note before we wrap up. This conversation is for educational purposes only. Mutual fund investments are subject to market risks, so please always read all the scheme-related documents carefully and consult with a professional financial advisor before you make any investment decisions.